Welcome to Seminar 4. The problem we're addressing this week is how do we move from an appreciation of a firm's business conditions and strategy and how that's reflected in the accounting through to a set of financial statement forecasts that will be useful to us. That's why this week we focus on financial analysis. The goal of financial analysis is to assess the performance of a firm in the context of its stated goals and strategy. There are two principal tools of financial analysis: ratio analysis and cash flow analysis. Ratio analysis involves assessing how various line items in a firm's financial statements relate to one another. Cash flow analysis allows the analyst to examine the firm's liquidity and to assess the management of its operating, investment, and financing cash flows. Financial analysis is used in a variety of contexts. Ratio analysis provides the foundation for making forecasts of future performance. As we will discuss in later weeks, financial forecasting is important for company valuation, credit evaluation, financial distress prediction, security analysis, mergers and acquisitions analysis, and the analysis of corporate financial policy. We focus on two types of comparative analysis. The first is time series analysis. This is where we compare a single firm's performance over time. This allows us to identify trends in performance. The second method of comparison is cross-sectional analysis, where we compare the performance of our firm of interest to a peer firm or some benchmark comparison group. Of course, you can combine these two and compare your firm against a peer or benchmark over time. A key point that we stress in our discussion of ratios is that there is no single benchmark set of numbers that firms should be achieving. You need to understand how well the accounting rules allow your firm to accurately reflect its underlying performance. One obvious difficulty that arises when undertaking cross-sectional analysis is trying to identify the appropriate comparison group. Remember the aim of your financial analysis. You're trying to work out how well your firm has been performing. So the point of having a comparison group or peer firm is to try and identify firms that are likely to have been doing similar things. That is, undertaking similar transactions, facing the same sorts of risks, having the same sorts of opportunities, and having similar accounting rules as your firm. In that way, you are trying to remove as far as possible differences in ratios that are not coming through firm performance. This is where your accounting analysis is important. Having an understanding of whether your firm is adopting similar accounting policies and choices as its peer firm will help you in determining whether it is underlying performance differences or simply accounting choices that give rise to differences in your ratios. Typically, we focus on benchmark firms that are in the same industry as our firm of interest, and we then might typically match on firm size. You'll find, though, that this is not always as straightforward as it sounds. Sometimes it can be difficult to find one good match or even a good industry match. The best match might be a private firm for which you can obtain limited data. Your task as an analyst is to keep in mind how any differences between your firm and the comparison group could affect the observed ratios. A useful starting point for our ratio analysis is return on equity, ROE. We measure return on equity as income divided by shareholders' equity. It's an overall accounting measure of performance from the perspective of a shareholder. ROE is useful since we know how measures of ROE tend to behave over time for large samples of firms. It exhibits what we call a mean reverting pattern. That is, extremely high or low levels of ROE tend not to persist. This pattern is consistent with the way a competitive economy works. Capital gets allocated to opportunities with high potential or high ROEs and away from low-performing opportunities. ROE is also useful in that we can decompose ROE into components that tell us something about the various ways in which managers can affect firm performance. A common way of doing this is termed the Dupont analysis. In the Dupont analysis, we break ROE into three components: profit margin, asset turnover, and leverage. Profit margin, income divided by sales, tells us about the success of operational strategies. How much income are we generating from each dollar of sales? Turnover, sales divided by assets, tells us about investment efficiency. What level of revenue is the firm generating from each dollar of assets in the business? Finally, leverage, assets divided by equity, tells us about the way in which the firm's financed. We know that there is typically a trade-off between profit margins and asset turnover, and that it can be difficult for well-performing firms to increase both measures simultaneously. Capital-intensive businesses tend to have low asset turnovers from the high levels of property, plant and equipment, and high profit margins, while industries such as grocery retailers tend to have low profit margins but high asset turnover. Thinking about how your firm sits against typical industry measures can help you consider how well its chosen strategy is working and how the ratios may change over time. One issue we face using the traditional Dupont composition is that it does not distinguish between operating and financing assets. So measures of turnover, sales divided by assets, would treat plant and equipment the same as cash. Similarly, the measures of income do not distinguish between income generated from the operations and income or expenses generated from the way in which the business is financed. To deal with this, we can isolate the operating items from the financing items in the income statement and the balance sheet and use what is called an alternate Dupont decomposition. In this setting, we focus on measuring operating profitability, that is, net operating profit after tax, relative to sales, and the efficiency of operating assets, sales divided by net operating assets. These two items multiplied together give us the return on net operating assets. We can then compare that figure to the after-tax cost of borrowing funds. If return on net operating assets is higher than the borrowing cost, then having additional borrowings will increase the return to shareholders. That is, return on equity will be higher than the return on net operating assets. We're asking you to calculate these ratios for Kathmandu before your class this week. Doing the calculations yourself will help you get a better understanding of how the financial statement items work together and will be good preparation for your work in the major project. More recently, we have observed that firms have been accumulating larger and larger amounts of cash and marketable securities on their balance sheets. This further complicates our ratio analysis. One way to deal with this situation is to incorporate a separate component for investment items. So your analysis would comprise of operating, investment, and financing effects. Again, we'll go through this in class. Finally, you should also undertake analysis of the cash flow statement. The cash flow statement will give you information on how well your firm is generating cash in its day-to-day operations, the extent to which it's investing in growth, and the way it's going to be undertaking and meeting its financial obligations. The relative levels of operating, investing, and financing cash flows will vary over a firm's life cycle. Indeed, many of the ratios will vary systematically with life cycle, that is, whether the firm is young and growing, mature and stable, or declining. In summary, ratio or financial analysis allows you to undertake a systematic assessment of firm performance. You can use it to identify trends over time and compare performance to peer firms. Understanding performance is the starting point for making good forecasts. So the better you understand your firm's strategy and the way in which the strategy is reflected in the accounting, the better you'll be able to assess current and recent past performance using financial statement ratios.